Hi everyone, Scott Schweiger back with another Tuesday tax tip. Last week we took a look at a little known provision of the CARES Act that affects SBA loans. This week we're turning the focus around virtual currency. Last year's Tuesday tax tips started off with sharing about how the IRS is stepping up enforcement and tracking of crypto. And we ended last year with a discussion of how the IRS treats crypto, which is more like property and not actual currency and not even an investment. It's kind of weird. Think personal property. With Bitcoin and virtual currencies on the rise in general, there's no better time than right now for another crash course in crypto. So first, even though crypto is more like personal property, there's still a reportable gain or loss on your taxes when you convert it. And I say convert specifically because it's not limited to simply selling it. If you use your virtual currency to buy something or exchange one virtual currency for another virtual currency, those are conversions and those are taxable events. Because of this, tracking your basis is key. Knowing the acquisition cost for each coin or fraction of a coin is necessary in order to report the correct gain or loss on your taxes. To throw another wrench in the system, you can use specific identification to track it. This means that if you bought, let's say, Litecoin for $100 and then later you buy Litecoin again but for $125, when you convert it, you get to choose which one of those you converted. Obviously, this will affect your taxes. So what about other ways to acquire virtual currencies? Well, you can mine it, and when you mine it, it's self-employment income. The self-employment income is the value you received. So if you mine a coin for $100, your income is $100. So you have $100 of self-employment income. And that also becomes your basis when you convert that coin in the future. So what about airdrops? Sorry, airdrops are income. It's considered income the moment you have control over the coin. And not reporting airdrops is not reporting income and considered tax fraud. So a lot of this is taxable. So what isn't a taxable event? Forks. Currently, both hard forks and soft forks for a cryptocurrency do not constitute a conversion or a taxable event. So a warning here, the IRS is not being lenient when it comes to penalties related to virtual currencies. So please report your virtual currency transactions, and if you use a tax professional, please let us know. Even if you're unsure if you have a reportable event or not, please let us know, because not telling us is not a defense if the IRS comes knocking. Okay, so obviously we've gone through a bunch of things here, and how it will impact you will depend on your particular set of facts and circumstances. Like, do you dabble in crypto or do you stay 10 feet away? So if you have specific questions, please reach out to your tax advisor or feel free to contact me directly. Thanks so much for watching, and I hope you join me next week for another Tuesday tax tip.